Welcome to our home buying seminar. I'm Sean Psaradelis with Team Psaradelis, and I am thankful that you're here as part of our home buying class. The goal of this class really is to give you some great tools and information that you can use to become a better educated home buyer. In this class, we're going to be talking about multiple aspects of home buying. It's a ton of information. So if you've got questions along the way, I want you to take a moment to maybe write something in the comments. I'll see if I can answer some questions at the end, or feel free and write your questions down, and let's schedule a one-to-one meeting where we can go over your specific situation. Here is the agenda for today. This afternoon, we're going to be talking about multiple different parts of the home buying process. And again, the goal is I really want to make you an educated home buyer. I love what I'm doing. I'm passionate about the business, and I really want to make sure that my buyers are fully educated so that they are successful home buyers. We're going to be talking about different aspects, beginning with where we start with the home buying journey. To begin, let me introduce you to my team. I work together with my brother, Brian. We've been working together for about 20 years. And his job in the process really is to help take care of loans once they're in process. He does a great job. We are adamant about solid communication. And really, if you have questions on home buying, you can always reach out to me or Brian. Erica is who you would speak to when you first reach out and you want to schedule a one-to-one. Or maybe you send in some of your documentation. She's the glue that holds the team together. Brian and I are very thankful to have her as part of the team. She does a wonderful job, very personable, and as always, customer service is her number one goal. So in working with Team Psaradelis, you may want to know who we are. I'd invite you to check out some of our reviews. We have over 290 reviews on Zillow, Google, Bird Eye, and I want you to see what our clients have to say about us. It's one thing for me to talk about our business, to talk about how passionate we are for helping people. It's entirely another thing for you to see what others have to say after going through the process. So feel free to Google search Team Psaradelis reviews and see what they say. So a little bit about me. I've been in the mortgage industry for about 22 years, going on 23 at the end of August. We've helped thousands of families. I've been in the top 1% of mortgage originators here in the United States, and we are licensed in multiple states. One of the things that really got me into this industry is growing up with a mom, single mom raising 6 of us. We didn't have much, but one of the things we did have is we had a home that we could call home. Things are pretty tight growing up in Snohomish, Washington. We didn't always know where mom's next paycheck was going to be. But one of the things that I remember is the security of knowing who the neighbors were in the neighborhood. We lived near Pilchuck River, being able to swim there every summer. And there's these constants in my life that really were there because we didn't have to move around. Had we been renting, we may have had to do that. So it was a big thing for me to have a house that we could live in and that mom could raise our family. So right now I live in Lake Stevens with my wife Charity. We have 3 children, 2 daughters going to the same college, and a 13-year-old son, Christian, who keeps me busy. We're usually following him with baseball and other kinds of sports. Really enjoy living in Lake Stevens. It's a great community. If you're from Washington, you know it's a beautiful one. That lake is something else. What I love about this industry, for me, the biggest reason I do what I do is to help others in their journey of homeownership. I really love this idea of someone coming to me with so many questions. They're not quite sure where to go for answers. And there's nothing better than walking people from start to finish, seeing the excitement on their faces. You know, a lot of my customers are first in their entire family to purchase a home. So it's a big deal, something that we take very serious. So where do you start your home buying journey? I believe it all starts with a question. What is your goal? Are you looking to buy your first home? Are you currently a homeowner? You're running out of space and you need a larger place. Do you have ideas of buying homes, turning them into rentals, and starting a portfolio of homeownership of homes? Do you have pets and you need some space in the backyard and finding a rental is becoming a pain? Maybe you want to purchase a second home. Where do you start? It all depends on what your goals are. And with that, we can find out how we can help get you to achieve your goals. So let's start off with this question. Does it make sense to buy now, or should I continue renting? Or does it make sense for me to sell and rent, or should I sell and continue buying? Well, I try to give an unbiased answer. Now, one of the things, if you know me, you know that I want to give good information without really pushing someone one way or the other. But let's take a look at some of the pros and cons of buying versus renting. I firmly believe it does make more sense to buy. Why is that? Well, there's a couple of things here. One of the things that you'll find if you are a home buyer is you're going to have more tax deductions being a homeowner than if you were not. If you're renting, none of that's tax deductible. If you own, you've got your taxes, your insurance, maybe even your mortgage interest that's tax deductible. Your property may earn appreciation. Here in Washington State, the prediction is that home appreciation is going to go up about just slightly below 5%. Whereas if you are renting, you do not get a chance to take advantage of that home appreciation. If you own a home, you get a chance to control the improvements. You get to paint the home on the colors you want. You get to do what you want in your backyard. You don't always get to do that when renting. And then finally, you've got the pride of ownership. You own a home, no one's going to make you move. You get a chance to do what you want with that home. You get a chance to raise your family if that's a goal of yours. Renting, the landlord gets a chance to tell you what your payments are. They get to increase your rent without really you having a say in the matter. Actually, the only say you get to say is if you decide you want to rent somewhere else. So if you've determined that purchasing a home is right for you, or you still want to continue down this path to determine if it's right for you, let's take a look at down payments. 26% of first-time home buyers say the most difficult part of buying a home is saving for a down payment. And that's true when you think about that. 47% of buyers typically take the time to save. 22% get that money from a gift or for a loan from a family member or a friend. But not all of us have friends or family that's going to give us money for a down payment. So what to do? One thing that I recommend to my customers, my clients, is do the practice payment plan. And here's how that works. Let's say you're renting a home for $2,500 a month. But in talking with me or another loan officer, you find out that your payments are going to be $4,000. One of the things I would tell you to do is continue paying the $2,500 a month in rent, but take that additional $1,500. Put that in savings. Well, what that's going to do is it's going to give you a couple things. Number one, you're going to be saving $1,500 a month for your down payment. Number two, you're going to find out if a $4,000 payment fits your budget. And if it doesn't fit your budget, well, that's okay as well, because now you've found out that a $4,000 payment might be a little too high for you, but you found out before you've taken the time to purchase a home. Once you do purchase a home, your $4,000 payments are due whether you have a hard time making them or not. So using this practice payment plan really helps you to save for a down payment and determine if that payment fits in your budget. Now, what about different types of loans? Well, let's start with the big picture. Most of us know about a fixed rate loan, a 30-year fixed, a 20-year fixed, a 15-year fixed. There are also adjustable rate mortgages. In this market right now, the adjustable rate mortgages really aren't as prevalent as they were in times past. I do think they'll make a comeback, they'll make a resurgence, but it's going to take a little while. But that being said, I still think it makes sense for you to have a good understanding. So your fixed interest rate is just what you would think it is. It's fixed, the same interest rate for the set period of time. If you pick a 30-year fixed, your rate's going to be fixed for 30 years. You pick a 20-year, it's fixed for 20 years. What about an adjustable rate mortgage? Well, you're going to hear things if you're looking at an adjustable rate mortgage of a 7-year loan or a 10-year ARM. What does that mean? In the case of a 7-year loan, a 7-year ARM, that means your interest rate is fixed for the first 7 years and then it adjusts afterwards. On a 10-year ARM, your rate is fixed for 10 years and then it adjusts afterwards. The reason someone would choose an adjustable rate mortgage is typically the interest rate is lower than a fixed interest rate. In this current market right now, what we're seeing is that the adjustable rate mortgage is the same interest rate as the fixed. So most home buyers are going to choose a fixed interest rate. But in the future, if it does adjust, you may want to look at an adjustable rate mortgage. Why would you do that? Well, let's just say you found a home and you knew that you were going to live in that home for 7 years. Maybe you knew you were going to live in the home for 5 years. You could choose a 7-year ARM. You could choose a 5-year ARM. What if you purchased a home and you knew you had a goal of paying it off in 3 years? Maybe you choose a 3-year ARM. So you see, there are different loan products on these adjustable rate mortgages that really can help tailor the payment and the interest rate to fit your budget. Thing to note, most adjustable rate mortgages are going to have caps to how high and how low the interest rate can go. So if you locked into an interest rate on a 10-year ARM at 5.5%, you may know that the cap, the highest rate it could go up to, might be 10.5%. The cap yearly might be a 2% maximum jump. Vice versa, if rates went down, the lowest that rate could go to would be somewhere around 0.5%. Will we see that? I don't know. But it's important to know that the caps on interest rates on adjustable rate mortgages, it's not just going to jump from 5.5% to 10% in 1 year. They've got limits. So if you're interested in finding out more about the adjustable rate mortgage, reach out to me. I'll happily give you some information that you can use to make a great decision. Now that we've talked about the different loan types, let's talk about the different loan programs that encompass fixed rate and adjustable rate mortgages. Let's talk about the first one that most people understand, a conventional loan. Here in the United States, the loan amount of $726,200 and below can qualify for a conventional loan. This is a great loan that allows you to put minimum of 3% down. You can put 5%, 10%, even 20% down if you want to. This is a loan that majority of people use when they've got a decent down payment or maybe they've got excellent credit. Now in some areas, there are high cost areas that allow for an even higher loan amount. So for instance, here in Washington State, in King County, Snohomish County, and Pierce County, the conforming loan limit is even higher than the $726,200. So every area is going to differ. Make sure and talk to your loan officer about what your area qualifies for a conforming. What if you've got a loan amount above the conforming loan limit? Well, the jumbo loan may be an option for you. These are loans that are above the conventional conforming loan limits. Most of them typically are going to require 20% down. These are loans that can sometimes go up past $3 million. So it's a great loan program if you're looking at those upper end areas where the home prices are upwards of $1 million plus. They do require 20%, like I said, although there are a couple of them that could require less. It's going to depend on credit score. It's going to depend on income. Feel free and talk to your loan officer about that. What about government-sponsored loans? This could be your FHA. This could be your VA or your USDA. These are excellent loan programs that may apply to you. Start with an FHA, minimum 3.5% down. One of the things I love about FHA is you don't have to have stellar credit. You could have a credit score as low as 580 and still qualify for this loan program. Does have mortgage insurance. Well, conventional mortgage also have mortgage insurance if you're putting less than 20% down. But FHA typically is going to have lower mortgage insurance if you compared it to 3% down conventional. So you can still get a great interest rate, minimum down payment, and you don't have to have stellar credit. The VA loan, to me, the VA loan is probably the best loan program out there, but you do need to be a veteran to qualify. VA is 0 down, 100% financing, and no mortgage insurance in your payments. It's a wonderful program. Oh, and if you're a veteran and you're disabled in any way, shape, or form while serving in the military, there's this thing called a VA funding fee. It's required on every VA loan, but if you're disabled, that fee is waived. So it's 100% financing, no VA funding fee, and no monthly mortgage insurance. It really can't be beat. It also has stellar interest rates. What about the USDA loan? Well, the USDA loan is also 0 down. It's got attractive interest rates. One of the things that I would tell my clients, though, is the USDA, although they tell you they'll go down to a low credit score, they really want to see good credit. A lot of times they want to see a credit score above 700. So if it's below that, it could be a good option for you. It might not. You may qualify for a little more choosing an FHA loan or a loan like that. We also have down payment assistance programs. What these programs do is they grant you money or they loan you money for a down payment. So let's just say, for example, you wanted to use the FHA 3.5% down, but you didn't have 3.5% down. Well, there are loan programs that could give you that money for a down payment. They may not even require a payment, but you would have to pay it back once you do sell the home or refinance it. There's a couple of really cool programs. Feel free and reach out to me if you got any questions. And then finally, income limited programs, the Home Ready or the Home Possible. I'm going to talk to you a little more about these programs in a bit, but here's what I will say. These programs are wonderful if your income limit is below a certain threshold, depending on your area. It allows you 3% down. It allows you to use a conventional loan, but the interest rate's a little better. The mortgage insurance is a little lower. It's a great both of these are great programs. So again, if you've got questions about those, feel free and reach out. Now let's talk a little more about the down payment assistance program. Like I had mentioned, it can be used for your down payment. You don't have to be a first-time home buyer and you don't have to have stellar credit. The one thing I will tell you, though, is there's an income limit that applies. Here in Washington State, that means having an income of below $180,000 a year. So it's not so low that very few people can qualify. Other states are going to have their own programs and and income limits. So before you assume that you qualify, if you wanted to buy a home, let's say in Arizona, we'd want to double check to make sure that your income qualifies. This does make you take an online or in-person first-time home buying class. I say first-time home buying. It does make you take a home buying class. So a couple of details that you'll want to see right there. Every state is going to have their own different program. We are familiar with most of these, so if you've got questions, feel free and reach out if you're looking at purchasing in different states. Now, I was talking to you about the Home Ready and the Home Possible loan program. Like I had mentioned, these are conventional loan programs, and you can use them for both a purchase or a refinance. You don't have to put a huge down payment for them. What they want to really make sure is that your income is below 80% of the median income. It's not statewide. It's actually specific to different geographical areas. So you may find that you need a certain income limit to purchase in one town, and the next town over may require you to have a different income. Again, the home buyer class is required. If you want to find out more information, you can reach out to me, or I've referenced a couple of websites for you to take a look at as well. So we've really talked about the majority of loan programs that are available to pretty much everyone. There are a couple of programs that I would like my customers to understand because they could save you some money or save you some time, or they could help you win a deal in this competitive market. The first one is called the STAR Loan Program. This loan program is a great one. It gives you over $800 in reduction of fees. This is meant for teachers, principals, counselors. It's meant for police, for your sheriff, for your troopers. This is meant for firefighters, first responders, nurses, border patrol. If you or your spouse or someone you know fits this job description, feel free and reach out and we'll give you more details about our STAR program. It's a wonderful program. It's a way for us to say thank you for your service to your community. What about the Keys on Time program? This program is a great one. Let's just say you find the right property and you want to offer a competitive offer to the seller. The one thing the seller doesn't want to have happen is they don't want you to go over or go past the closing date that you told them you would hit. Well, this Keys on Time program makes it so that we have to hit the closing date. If we don't, we're going to pay you $2,000. It's a great program. It allows you to have the seller feel more at ease knowing that you are a serious buyer. And it helps put you at ease knowing that your lender is going to close on time. So we've talked about different loan programs. We've talked about some special programs. I think the most important part of home buying is understanding the payments. What's confusing is if you're looking online and you take a look at mortgage payments, a lot of times they may just give you one part of the payment. Or they may give you information about other aspects of the payment, but really not give you good information for you to make an educated decision. Here's what the breakdown of a mortgage payment looks like. You'll hear lenders say, what's your PITI? Your principal and interest, your taxes, and your insurance. This is what you should be asking for. Before you place an offer on property, you want to get a good idea of what your PITI payment is. How do we break that down? Well, your PI is your principal and interest. That's your mortgage payment. That's what you're going to be paying on your principal by paying it down and your interest. What about your taxes? Taxes are important. The county that you purchase your home, or the city sometimes, may charge taxes. Well, they will charge taxes for your property. It's important for you to know what the accurate taxes are on the property you buy. So one of the things that Team Psaradelis does is when we see that you're looking at a specific property, we'll find accurate taxes and quote those to you. We want to make sure you understand exactly what that payment's going to look like. It's also important to note that the county can raise or lower taxes yearly depending on the value of your property, depending on the tax bonds that were passed the year before. What about homeowners insurance? This is sometimes referred to as fire insurance, and it's an important aspect to make sure that you know that you've got insurance. This is different for different parts of the country. So for instance, if you lived in the state of Washington, your homeowner's insurance most likely is going to be less than if you purchased a comparable property in, say, California or, say, Texas. As you know, insurance companies are going to charge insurance premiums based on the potential of what could happen in areas. So, Texas, if you've got a chance of tornadoes, you may need to have higher insurance. Or in California, if they're worried about fires, you may have to pay higher insurance. A lot of times we're going to know the area you're looking at. We usually will speak with our insurance agents of those areas, in those areas, and make sure we're quoting you as accurate of insurance as possible. What about PMI? I talked to you a little bit about PMI. Here's what it is in a nutshell. It is required if you are putting less than 20% down on your home. So if you're talking to a mom or a dad, or maybe an aunt and uncle, and they may tell you, no, avoid mortgage insurance, it's bad, you don't want to pay it. Well, I'd like to offer you a different way of thinking about things. The lender is always going to judge the situation, the home that you are buying, in regards to risk to them. Let me explain. If you've got a lower credit score, let's say you've got a 620 credit score, and your next door neighbor has a 750 credit score. and you purchase a home at the exact same time. Well, the lender may determine the 620 credit score is more risk than a 750 credit score. Or let's say you're putting 3% down and your neighbor's putting 20% down. The lender may determine that your 3% down payment is higher risk to them than 20%. In other words, there's a higher chance of defaulting on the loan, putting less money down than more money down. Well, a lender needs to mitigate that risk. And how would they do that? Well, back in the day, what they would do is they'd charge you, a home buyer, a higher interest rate. But nowadays, what you'll find is you may get similar or the same interest rate having a 620 credit score as a 750. But the mortgage insurance might be higher with a lower credit score. Or you may find that you would pay higher mortgage insurance putting 3% down versus putting 15% down. So the mortgage insurance, what that does is that helps the lender mitigate risk, but what it does for you as a buyer is it keeps your interest rate low. And here's the great thing. If you're using conventional financing, you may have to pay mortgage insurance for only 2 years. And then once you show the lender that you've made 2 years of payments on time and that you've got 20% equity in your home, that your home is appreciated enough where you now have 20% equity, you can ask the lender to remove that mortgage insurance. So what's that mean? That means you got the lower interest rate, but you did have mortgage insurance if you put less than 20%, but then you can ask the lender to remove it. It's a pretty cool concept. It's actually not a bad thing. And the mortgage insurance is different for every buyer. So a conventional loan is going to have different mortgage insurance than the mortgage insurance on an FHA, which is going to be different than the mortgage insurance on a USDA. What I'd recommend you do is talk to your lender about the different options, but make sure when they're quoting payments that they're quoting the mortgage insurance in there. Finally, the one thing that you should pay attention to is if your home has HOA dues. Here in Washington State, we don't have a lot of neighborhoods that carry HOA dues. But if you lived in areas like Arizona, you're going to find that the majority of large neighborhoods are in an HOA. So if we're quoting you payments or your lender's quoting your payments, you want to make sure that they're including the HOA dues. Why? Well, because you want to know exactly what you're getting into before you purchase a home. Instead of them just quoting you one aspect, you want all of these. So, now that we've talked about the breakdown of a mortgage payment, what are some options to reduce your payments? There are a couple of things that you should be aware of. There's the permanent rate buy down and there's a temporary rate buy down. Let's walk through both of them because to me, this is another part of the process that is so important for you to understand. Start with the permanent rate buy down. So most buyers, when they are talking to lenders, they're going to call a lender and say, hey, what's your current interest rate? What a buyer doesn't know is that a lender has a multitude of interest rates that they can choose from. They could choose 7%, 6.875, 6.75, 6.5. They could choose 6%. They could choose 5.875. You as a consumer, what you should know is this. You will pay more upfront, a permanent rate buy down. You're going to pay more fees upfront to get a lower interest rate and save more over the long term of your loan. Let me explain that. If you're borrowing $500,000 and you're at an interest rate of 7% and you wanted to compare a $500,000 purchase at 6.5% interest rate, but you knew you were going to hold that property for 10 years, it may make sense for you to pay extra upfront to get that lower interest rate of 6.5. Let's just use easy math. Let's say you were going to save $50 a month, but it was going to cost you $5,000. That would take you 100 months to break even. So the question I would ask you as a consumer is, how long do you intend to live in your home? If you know you intend to live in your home for over 100 months, it could make sense to buy that interest rate down. There's no one right answer. It's more an answer of what's right for you and in your situation. What about the temporary rate buy down? This is a great program and it's utilized by an awful lot of buyers. Here's what this looks like. Temporary rate buy down allows you to temporarily buy down your interest rate. Well, that's kind of not really true because you don't get to buy down your interest rate. It's just a way that lenders explain it so consumers understand it. Here's what it really looks like though. Let's say you locked in at an interest rate of 6.5%, and you asked the seller to participate in this temporary rate buy down. If the seller agrees to it, what they're going to do is they're going to put some money off to the side, and for the first couple of years, if it's a 2-1 buy down, or the first 3 years if it's a 3-2-1 buy down, you're going to have lower payments. And what happens is the money that the seller gives to you at the beginning is going to be pulled out monthly to help offset your payments. What you should know as a buyer is you have the option of buying down your interest rate through either a permanent rate buy down or a temporary rate buy down. And what that does for you is that allows you to get lower payments. It can really help buying a home fit into your budget. There's two different types, permanent rate buy down and the temporary rate buy down. I'm going to show you examples of both of them. Okay, let's start with the permanent rate buy down. Let's give you an example. Let's say that you are purchasing a $550,000 home. And if you take a look at this chart here, you're going to see that I've quoted 6.5%, 6.25, and 6% interest rates. That's the third line down. Well, you can see as your interest rate decreases, your payments decrease. Your monthly savings increases. But in order to get those lower interest rates, you would pay money up front. They're called points. So if we take the example of 6.5 versus 6.25, it would save you roughly on a $550,000 purchase, putting 10% down, about $81 a month. But you would pay money for that $81 savings. You would pay approximately $2,475. Well, what if you want an interest rate of 6%? Well, you would now save $161 if you compared that to the 6.5, but it would cost you nearly $5,000. And so what you would do is you would first determine how long you intend to own and live in the home, and then determine if it makes sense to pay money up front to get a lower interest rate and get lower savings in your monthly payments. It's a very important concept to understand. It can be confusing, and the one thing I would highly encourage you to do is when you are shopping for a mortgage, that you take the time to talk with your lender about what this really looks like to you. Because here's the deal, interest rates change every day. So it's not a simple equation of, okay, I was quoted 6.5, but I want to get 6.25, and Sean told me it's a cost of $2,475. That adjusts daily. So you want to talk with your lender based on your specific situation. What about a temporary rate buy down? Oh, excuse me. Let's take a look at that exact same situation, a $550,000 purchase price, putting 10% down. The difference between a temporary rate buy down versus a permanent rate buy down is that the temporary one is only for a set amount of time, which means your payments are lower for only a set amount of time. Now, this temporary rate buy down, you've got multiple ones to choose from. You can choose a 1-0 buy down, which means your rate's lower for 1 year. You can choose a 2-1 buy down, which means your rate's lower for a couple of years. Or you can choose a 3-2-1 buy down, which means your rate's lower for the first 3 years. In this example, we're going to talk to you about a 2-1 buy down. So looking at that same situation, $550,000 price, putting 10% down, your payments, the first year is reduced by $621. Your second year, reduced by $318. you can take a look below that your first year drops it from $3,700 a month down to $3,080. That's quite the savings. Second year, $3,382, and then the third year thereon, $3,700. So why would someone choose this temporary rate buy down? Why wouldn't they just do the permanent rate buy down? Well, here's the biggest reason why I see people using this product. Let's say that they are purchasing a home and these payments the first couple of years and the price point they're looking at is just a little bit out of reach of their budget. This temporary rate buy down allows these payments to now fit their budget, and they get to go up gradually over the course of a couple of years, allowing them to get more accustomed to the payments. Or maybe your situation is, you're going to receive a raise in the next couple of years. Maybe it's a substantial raise. So this allows you to purchase the home you want to buy while still keeping the payments lower for you and your budget. It's a great product. If you'd like more information, feel free and reach out and we'll talk you through what your options are. So the permanent rate buy down and the temporary rate buy down, both good ideas to understand. Now, the next step in this home buyer class, let's talk about how you would qualify. Most people don't really understand how they qualify. They think to themselves, hey, if I've got money in the bank, I should qualify. Or if I've got a good job, I should qualify. Or if I have excellent credit, I should qualify. But really, it's a combination of multiple things. The lender looks at credit, income, assets, but also the property you're purchasing. Let's talk through each one of those. Let's start with credit. Credit is the willingness to repay your debts. A lot of confusion on credit scores, but let's break it down on what this really looks like. If you're wondering how your credit score is determined, here's what this breaks down as. 35% of that is based on your payment history. Have you been making payments on time? 15% is the length of credit. How long have you established credit? 30% of your credit score is what do you owe? As a matter of fact, it's what do you owe compared to what you have available. And then 20%, how much are you using your credit? When are you establishing multiple new credit lines every few months? So all four factors play a role in determining your credit score. Your score is important. Like I had said, most mortgages are going to require a 580 to a 620 credit score minimum. These scores are not the same as consumer credit scores. So if you've got a credit score through your credit card or through your local bank and you say, hey, I think my credit score is 700, a lot of times what I'm finding is when buyers go to get pre-qualified, that score is slightly lower. And so I don't want that to be a surprise to you. I still think looking at your consumer credit is so important, but it really gives you a chance to understand how your score is determined. And then when you speak with me or a different loan officer, then we walk through what your score looks like from a lender's standpoint and how we can improve it, what we can do to help you. There are some significant waiting periods if you've had a bankruptcy, if you've had a foreclosure. So if that fits you and your situation, you want to make sure and talk with your loan officer about what those waiting periods would look like. It's different than your credit score. It's specific time frames on how long you need to wait after a foreclosure, after a bankruptcy. Matter of fact, here are a couple of years to show you what it takes after you've had a negative mark on your credit. Shows you your foreclosure if you've had a short sale, Chapter 13 bankruptcy, or maybe a Chapter 7.
I think this is kind of important. Let's do that from the beginning.
Okay.
Yeah.
Which part? All of it?
No, just the going over to showing that how when you get the recovery. Yeah, that one.
Okay.
Yeah.
Okay. Okay. So what if you have had a foreclosure or a short sale or a bankruptcy? How long should you... So what happens if you have had one of these derogatories on your credit? Maybe you've had a foreclosure. Maybe you've had a bankruptcy. How long of a waiting period do you need to wait before you can purchase a home? Well, with every loan program, it's a different story. So for instance, if you were looking at a conventional loan, you may have to wait 7 years after a foreclosure versus FHA 3 years and VA 2 years. Or what if you've had a Chapter 13? Conventional may make you wait 2 years, FHA only 1 year. Same with VA. So depending on the loan program you're looking at and depending on your situation, it's going to be different. That's good. Let's try that one more time.
This is good info, though.
Yeah, I think so too. What's funny is it's been about 2 months or so since I've given this presentation,
this is
and I
a
can tell.
attention grabber for sure.
Is it?
This slide. Yep.
Can you buy a home if you've had a past negative mark on your credit? Yes, but there are certain waiting periods you'll need to know. So for instance, if you're looking at a conventional loan, but you've had a foreclosure, you know you'll need to wait 7 years. However, maybe you switch and look at an FHA loan where you only need to wait 3 years. If you're a veteran, that's only 2 years. Or what if you've had a Chapter 7 bankruptcy? Conventional is going to make you wait 4 years, but FHA and VA may only make you wait 2 years. So it's important to understand different loan programs because you may be able to purchase home with less time than you may have thought. Now, there are some ways we can improve your credit, and I think it's very important for you to understand this. If you've had negative credit in the past, not doing anything is not the answer. Is that a double negative? It might be, but it's still an important aspect of this. You need to build your credit. You have to continue using your credit. So if you've had a negative mark in the past, I want you to still continue making your payments on time. I want you to keep your revolving credit at about 30% or less of what you owe to what your maximum is. So if you've got a credit card with a max limit of $3,000, that means I'd want you to keep your balance at $1,000 or less. Once you move past that 30%, you're going to see your credit score drop. Don't close any of your unused accounts. If shopping for a loan, focus on a 2 to 3 week period where you have lenders pull credit. That's okay. The credit bureaus understand your credit score is going to be pulled by multiple lenders. So don't let anyone tell you that you should be wary of it. Just don't go and get your credit pulled by 20 different companies over the space of a month. If you do have negative credit and you're wondering how to improve it, well, the first step is to talk to Team Psaradelis. The second step is we can refer you to a credit repair specialist if that fits you and your situation. Now, what about income? Why is that important? Well, for lenders, they want to make sure that you've got the income to qualify. And for a W-2 employee, it's going to be different qualifications than if you are self-employed. If you're a W-2 employee, we may be able to take a look at your income over the past couple of years, or if you just got a brand new job paying you a salary, we could look at that income and use that immediately. You don't need to necessarily wait. Again, everybody's got a different situation, so it's not a one-size-fits-all, but it is important for you to know that if you just got a new job, you still may be able to purchase a home. Not always the case with self-employed borrowers. I can't tell you how many times I speak with borrowers that own a company, and they'll tell me something like, hey, last year's income wasn't great, but this year is fantastic. What you should know, if you're self-employed, lenders are going to look at your tax returns to determine your income. So they're going to look at the last 2 years, or if you've been in existence self-employed for 5 years or more, they may only look at the last 1 year. That's an important aspect. Here's a secret. Let's say it's the end of the year and you're about ready to file your tax returns, and you know that buying a home is important to you for the next year. Before you go ahead and file your tax returns, you want to make sure you speak with Team Psaradelis or you speak with a lender to find out what your income needs to be to qualify for a specific home, and then speak with your CPA. because your CPA wants to write off as much as possible to save you taxes. But guess what? The more you write off, the less income a lender can use. So you want to make sure that that lender tells you what your income needs to be, and you relay that to your CPA so that they make sure that that income shows on your tax returns. Again, if you've got questions on that, please reach out. Oh, did you know if your income isn't high enough to purchase a home, you may be able to use a non-occupant co-borrower? Yeah, you heard that correctly. That means you can use mom or dad. That means you can use an aunt and uncle, a brother or a sister. You may even be able to use one of your best friends to help you qualify. They could be on the loan with you, and they don't have to live in the same home. If you have more questions on that, please reach out. So, we took a look at your income, your W-2s, what's important there. If you're a self-employed borrower, what's important there. How do they determine how much you qualify for? Well, let's take a look at this. Let's give an example. Let's say you're looking at a purchase price of $450,000 and you're going to put 5% down. Let's use the example of a 6% interest rate. That's going to be payments of around $3,120 if we include the principal and interest, taxes, insurance, and mortgage insurance. And let's say your income is $8,000 a month. Well, that $3,120 payment is roughly 39% of your gross $8,000 a month income. But wait, what if you have a car payment of $350? Well, if we now include the $350, that means your total debt with the new mortgage payment is $3,470, which is about 43% of your gross income, $8,000. So it's important because when you're talking with a lender, they're going to be giving you information on what your debt to income is. They're going to ask you what's your income, they're going to pull your credit report, and they're going to give you a percentage. You've got 43% DTI. It's kind of a confusing thing. Here's what you should know. Most lenders in helping you qualify can use up to 50% of your gross income. So that means if you were making $8,000, all of your debts, the new house payment and any other monthly payments you have, can be $4,000 or less. Again, with your specific situation, I'd recommend reaching out where we can give you exactly what your DTI is. So we've talked about credit, we've talked about income. Let's talk about assets, money in the bank. When you're qualifying for a loan, there are some assets we can use, some assets we can't use. We want to be able to verify the money you have for a down payment. What that really means is if you've got mattress money, you've got $20,000 that you keep in your safe, and you want to use that for your down payment, it's not always easy just to pull that money out of your safe and put it into your bank account. It doesn't work that way. We want to be able to verify where the money comes from. So we're going to be looking at your checking and savings. We're going to look at your 401k. Guess what? You can also get a gift for your down payment. You can also get a gift for your closing costs. So if you need $10,000 and mom and dad are willing to give that to you, we can use that. We just have to be able to show where the money is coming from. We need a paper trail. Now that we've talked about you qualifying for a home, what about the property? Why is that important? Well, let's go back to the first thing that I had said when I was talking to you about risk, that banks always look at risk. They also look at the risk factor of the property. So if you are buying a single family residence, well, guess what? The majority of Americans also want to buy a single family residence. What if you want to buy a log home? Less people are willing to buy a log home, which means higher risk. What if you want to buy a condo or a manufactured home? Less people want to purchase those, and it's a higher risk to the bank. The bank is always paying attention to say, okay, if our borrower fails to make their payments and we have to sell the property, what's the odds of us selling it quickly? Well, single family home, they can sell fairly quickly. Some of the unique homes, they may not be able to. So all that to be said is this. If you are shopping, you find a manufactured home that you want to purchase. Typically, it's going to be a higher interest rate on that manufactured home than if it were a single family. So again, you want to make sure and reach out to Team Psaradelis, or you can reach out to your lender to get an idea of where interest rates are on specific properties. Just make sure and tell them what kind of property that is. Aside from what the property is, we also want to make sure it's in the right condition. So if you're buying a fixer-upper, you may have some trouble qualifying on that. We want to make sure that the home is livable. We want to make sure that there's heating, that there's a water supply, that the basement and crawl spaces are clear, that they're dry. We want to make sure that it is not a safety issue for you to purchase a home. So some of the examples I've seen in the past, I've seen people want to buy homes and they've got a slider off the kitchen and the slider has no deck in front of it. Guess what? A lender's not going to let you purchase that home without either installing a new deck or taking out a renovation loan. I haven't really talked much about the renovation loans because honestly, it doesn't happen very often. But if you're interested in finding out more information about a renovation loan, feel free to reach out. We can walk you through what that looks like. So that's a lot of information, isn't it? And again, I just want to relay that the goal of this class is to give you a 10,000-foot overview on what purchasing a home looks like. From here, I think it's great for you to do your own homework or set a one-to-one meeting for us to talk through what that may look like for you. The next step, if you have learned a lot of this information and you decide, you know what, I do want to take that next step of purchasing, well, you're going to meet with a lender and they're going to get you pre-approved. They're going to ask for some documentation though, things you should want to be aware of. They're going to ask for your W-2s. They're going to ask for your tax returns and your pay stubs. They're going to ask for your asset statements. That is your first step in getting in your home buying journey. I would actually tell you that that's your step before you speak with a real estate agent. So the last thing I'd want you to do is go out looking at homes and then talk with the lender because you might find out the payments don't work in your budget. But if you talk the numbers first, you're going to know what your budget can afford. So then when you speak with a real estate agent, they're going to be able to show you homes that fit your budget. Oh, by the way, Team Psaradelis works with a lot of great real estate agents, the true professionals in our industry. So if you're looking at purchasing a home and you want a referral to someone that really knows how to take care of their clients, people that are strong negotiators, great communicators, answer their phones, feel free and reach out to us. We'll be happy to put you in touch with a true professional. Once you've spoken with a real estate agent, start shopping for homes. Matter of fact, I'd recommend that you go out and start looking at homes, start walking through them. Once you find the right place, now you're ready to put an offer on property. We've already talked about the numbers. You've already gotten pre-approved. You've looked at different properties and you know that this one is the right one for you. It's time to put an offer on the property. And then hopefully, fingers crossed, get your offer accepted. Once you get your offer accepted, here's what the journey of home purchasing. Here's that journey of what the process looks like. This graph here is something I send to every one of my clients. So I'm showing this to you, but if you are a client that works with Team Psaradelis, this is one of the first things you're going to receive. This walks you through the different steps, and it shows you the parts of each one, so for instance, the pre-approval, finding a home, getting the home inspected, signing your initial loan disclosures, processing and underwriting your loan, getting your loan fully approved, having us send documents to escrow, reviewing the numbers before you go and sign your paperwork, then signing your paperwork, and typically 2 days afterwards, the home is yours. We try to walk through this entire process with our clients, making sure they understand every step in the home buying process. It's important to know, it's important that you work with a loan officer that is readily available that can walk you through these steps. There is nothing worse than looking at buying a home and having unknowns. So if you are willing to take the next step, if you know that this is something that works well for you and in your situation, I would encourage you to reach out to what my opinion is the best loan officer team in the country. We love what we do. We love helping our customers. We love working with them from start to finish, love answering questions, and I really enjoy teaching people the basics of home buying. So if that fits you, we'd love to take that next step with you. Thank you again. We've come to the end of our home buying presentation, and we will open it up for questions. But for those of you that are watching this video, I want to thank you so much for coming and look forward to helping you on your home buying endeavors.